I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Senior Investment Strategist Ryan Grabinski. Ryan, how are you doing this morning?
Great. It's great. Another update in the markets this morning, so that always makes the day more enjoyable.
Oh yeah, absolutely. It's been a lot of those lately. I think we'll talk a little bit about some of the reasons why, what you all are seeing. Obviously, Q3 was a great quarter for the markets, but let's start with, the fundamental underpinnings, right? A lot of things get talked about with this market. But one thing that goes under discussed probably every quarter is the earnings picture. I want to get your sense of earnings as we head into Q3. I know you all recently raised your estimates for S&P 500 earnings, so I want to get your insight as to what was behind that as well.
Yeah, certainly. I mean, I think the bottom line, in the most simplistic terms, the bottom line is that the fundamentals of the market remain strong right now. Obviously, the second quarter, we saw a great second quarter in terms of earnings. They surprised to the upside, exceeding Liberation Day levels. I'd say as we head into the third quarter reporting season, one of the things that we haven't seen that we typically see is a downward revision pattern. And in fact, we've actually seen estimates revised higher. I wouldn't be surprised if you had a significant beat this quarter, considering that they haven't been revised back to the pre-Liberation Day levels. Now, I'm not saying they have to get back to those levels, but we're still about $4 or $5 away from that. Part of the reason why we increased our earnings estimates for the full year overall is because we just haven't seen the tariffs making a big hit into the earnings thus far, and it's hard to foresee that happening in the future at this point in time. I basically what we did was we added back the $10 that we removed from our earnings estimates back when around Liberation Day. So we sit at about 265 this year. That's in line with the consensus estimate next year, or this for the remainder of this year, and then into next year, we're showing about a 9 to 10% earnings growth rate overall. So overall, the fundamentals remain strong. Top line growth is also strong as well, coming in at about 6% over the last couple of quarters, and is projected to be in that realm for the next few quarters as well.
Yeah, strong top line growth. And as you all have noted, that's really flowing through to profit margins. These companies, despite all the cost, raw material headwinds, are just squeezing as much as they can out of that top line revenue. So really impressive stuff. And another, I think, underpinning of this bull market, this economic resilience has been the consumer story. Now we've gotten a lot of softer labor market data, but it hasn't really yet hit consumer spending. And I want to get your take on one of Strategis's kind of out of consensus calls for 2026, which is a consumer spending wave, an actual kind of tailwind to the economy from the consumer. What is driving that? What's your all's thesis behind that idea?
Absolutely. A consumer spending wave in 2026 is certainly something that we foresee happening at this point. There's several reasons for that. The first is that it's the 250th anniversary of the United States, and you just have to imagine that Donald Trump is not going to he's going to do everything in his power to make sure that the U.S. does not head into a significant slowdown. On top of it, you have the World Cup, a global sporting event that could potentially shift the dynamics of what is hitting in the news headlines every day. I would not underestimate the sentiment that ultimately comes from that. In addition to with the World Cup, is likely to come more international travel to the United States. The FIFA Association actually estimates that the World Cup could be about a $17 billion addition to GDP in 2026. And that, the way we see it, is largely going to be attributed to the travel and leisure industries overall. If we think about the infrastructure that comes with such a large sporting event, the U.S. already has that infrastructure in space. So a lot of that's not going to be spent on infrastructure. On top of it, you also have the one big beautiful bill, tax incentives that will ultimately kick in for the consumer in February, March, and April. There's about $150 of incremental tax refunds that come of that bill due to the extension of child tax credits, the increase in the standard deduction, the returning of SALT. We also are in the midst of a rate cutting cycle. Rates are likely to be supportive. If we just think about financial conditions are going to continue to be favorable for the consumer in early 2026. So when you combine all of those things, it really is sending a message to us that we could see a really strong first half for the consumer more broadly.
Yeah, I love that. And obviously that drives most of the economic growth in the United States. So that would be huge for us. And I love it because it's out of consensus, but there's a lot of evidence there. So this has been a really good insight into that. We'll get you back sometime before 2026 to get the update on the theme, but I love the idea. Ryan, thank you so much for the time as always, and we'll look forward to
Thanks for
talking to you
having me,
again soon.
Ross. Thanks for having me.